Hi, I'm Todd Lard, a partner at Eversheds Sutherland Salt Group.
Hi, I'm Todd Vitor, an associate in Eversheds Sutherland Salt Group.
We're going to spend a few minutes today talking about the state tax implications of federal tax reform. The obvious cornerstone of federal tax reform was a dramatic decrease in the federal taxable income rate. That kind of change doesn't have a lot of implications for state taxes, but what does have a lot of implications for state taxes are the significant changes in the way that federal taxable income is computed. So we're going to spend a few minutes walking through maybe a decision tree that taxpayers might have to think about as they decide how those changes at the federal level will be reflected in state taxable income. Todd, can you kick us off talking a little bit about the base issue?
Yeah, in considering the state implications of federal tax reform, there really is this gating question, and that is whether or not a state conforms and how they conform to the Internal Revenue Code or the IRC. Typically that falls into whether or not they fall within three main categories of states in their conformity. The first being a fixed conformity or static conformity, and those states are ones that conform to the Internal Revenue Code as of a certain date and time. Then you have your rolling conformity states that basically conform to the IRC as it is day by day. So if the code is amended on May 19th, then that state conforms to the code as of May 19th. And then you have your selective conformity states that basically pick and choose which code provisions and when to conform to them. And with that, you have a mixture of the three at a state-by-state level. And because you have this such complexity here, it's important for taxpayers to be well aware of each individual state's conformity to the code and how that operates.
And this is really the first step in the analysis, Todd, and it's a bit of a moving target too, right? We've already seen a lot of states that have actually acted legislatively to change their conformity date this year.
That's right, and states have actually gone back and forth in the legislative processes whether or not to conform to the new changes or to stay with the old code.
Now let's spend a couple of minutes talking about some of the key provisions of federal reform and what that means to state taxpayers. Obviously, the provisions that have gotten a lot of attention are those that really dramatically changed how the federal government taxes foreign income and foreign operations. And how the states might pick those up and conform to that is a bit of a sticky question, but especially when it comes to things like what we call GILTI and FDII income or FDII income that people are referring to. So when a taxpayer is to think about that, you start off with what Todd was discussed, which is figuring out whether or not there is federal conformity. And once you get past that, I think it becomes a little bit more of a delicate exercise to try to figure out what the states are going to do with this foreign income. Do they? You can look at some analogies, what they do with Subpart F currently. You can look at what they do with their foreign DRD, and you can draw some analogies. You certainly have to keep track of the guidance that the states are offering. Once you get past that, you still have to look at some of the traditional issues that we look at as state tax lawyers, and that is the Commerce Clause. Does craft apply? And then the overall is the apportionment formula. If you bring this income in, how does it get apportioned, right?
Right.
And then on the domestic side, there's a couple key issues there as well, right?
So in addition to the federal rate reduction that Todd mentioned at the beginning of the presentation, there are two code provisions that are just kind of your general domestic provisions that are really important for taxpayers to be aware of. And the first one is 163J, which is your interest deduction limitation, which is actually imposed at a 30% of your AGI, or adjusted gross income. Historically, 163J had only been applicable in the international tax arena, but federal tax reform brings it in to also apply at the domestic level. And in addition to that, there's section 168K, which is your full expensing for 5 years. 168K, state tax practitioners may be aware of, is your bonus depreciation, which states have historically decoupled from. A couple considerations that taxpayers should be aware of in now analyzing these two provisions is really what your filing methodology is, how that 163J limitation should be calculated based on your separate filing, your combined filing, or consolidated filing, and then just whether or not states are historically going to continue decoupling from 168K or if they're actually going to conform.
Right. Hopefully that gives you a good high-level sense of what state taxpayers have to think about as they look at federal reform. For more information on the state implications of federal tax reform and other bottom-line videos, please visit eversheds-sutherland.com.